Hello and welcome to Currency Point, presented by me, Evan Lucas, for FP Markets. As always, please have a very good read through of the disclaimer on screen. Everything in this video is general in nature, none of which relied upon as any form of personal advice. FP Markets does not know your personal scenario nor your personal financial goals, therefore none of which relied upon as any full advice at all. It's just general in nature only. Slowing down does not mean stop, and I need to put that at the front and center, and I've said this before. The reason for it is that everything around that concept is playing out in FX because central banks are starting to show signs that they're possibly buckling a little bit under the pressure of what they have done in 2022. Everybody still expects rates to rise, and that's why I say slowing does not mean stopping. But we have had the RBA, who certainly it caught the market off guard, only raising rates by 25 basis points rather than 50 in the month of October, and probably going to do the same this coming Tuesday on the Melbourne Cup Day, when realistically some believe they should be going harder, but they've now been followed. You've now seen the Bank of Canada, who has been very, very aggressive, let's point that out there, with rate rises only doing 50 basis points rather than 75. And I say only, that's still an incredible rate rise to see where they're at. But you're also starting to hear the board suggest that they're possibly getting to the peak. And if they're getting to the peak, where does that mean for somebody like the Fed and also for the RBNZ? Because the RBNZ has been incredibly aggressive as well, and there are signs that they're actually putting some serious strain into the Kiwi economy. But the Fed's the one that matters because they are the ones that have been driving everything. The US dollar has been king, and in my view still remains king. But if you listen to some of the data, housing approvals are slowing down, housing starts are slowing down, consumer confidence is going backwards. And last week's Richmond Manufacturing Index fell significantly down to -10, and every part of that survey was down. So that's where the suggestion has come that maybe the Fed is also part of this idea that we're slowing rather than stopping, but we're not hiking at the same speed and veracity that we have in the past. Caveat to that, and that's where this needs to come out. The market still believes that by the end of this year, the federal funds rate will be somewhere between 450 or 464 basis points. That's at least 130 plus basis points from where we are now. That almost guarantees a 75 basis point at the end of November, and therefore December is a live event on what and how hard it could be. Is it 50 or is it 75? And that's what the market believes. That's not really slowing if you're really honest about it in terms of where they sit. So the dollar has fallen, and that needs to be pointed out. The dollar has fallen across last week. It's been falling now for about 6 or 7 days. Not unsurprising, considering how strong it has been. You look at dollar yen, it's gone away from 150, needed to. The BOJ has stepped in, real yields are falling. But you look at euro dollar, you look at sterling, they have crept back up. Sterling has had probably a reason behind it, finally a bit of stability in Downing Street, and also the fact that there isn't now a massive run on in markets. That's a positive, but there is still a lot to be done over there. So watch that space. But also, euro dollar was sort of going through parity again, and that's because the ECB raised rates for the third time in a row, 75 basis points, and are suggesting they're going to do so in the coming months. Thing that was dropped though was that it would be imminent, and I think that is also a sign that even the ECB, which is behind the curve, behind everybody else, is slowing after 3. So where does that leave everything, and where does that mean going forward? Well, what we now need to see, and what we're watching very closely, is how the Fed operates. If they are slowing, that will probably take a bit of heat out of the US dollar, and that's probably a good thing. But there is also an argument to be made that there is no signs yet at all through communication that the board is finished. And all of this still means that we are facing recession in 2023 and that we're facing a global slowdown. And where does money go in those scenarios? One place, USD.